On February 28, 2026, the United States and Israel launched coordinated military strikes against Iran, an operation the Pentagon named Epic Fury and Israel called Roaring Lion. Within hours, Iran's supreme leader, Ali Khamenei, was confirmed dead. Within days, the Strait of Hormuz, through which roughly one-fifth of the world's oil supply flows, went from the busiest energy corridor on Earth to functionally empty. Tanker traffic dropped to near zero. Insurance underwriters pulled coverage. Shipping giants suspended all transit. And yet, the first full trading day after the strikes, the S&P 500 barely moved. That disconnect between a war reshaping global energy infrastructure and a stock market that initially shrugged is not a sign that the risk is contained. It is a sign that the financial system processes geopolitical damage on a different timeline than the news cycle. And that timeline is where the real cost lives. Consider a man named Daniel. He is a logistics coordinator in his early 40s, living outside of Columbus, Ohio. He has a variable rate mortgage, a car payment, and a modest brokerage account he checks weekly. On the morning of March 1st, Daniel saw the headlines about Iran. He saw oil was up. He saw the market dip and then recover. He assumed, as millions of Americans did, that the system had absorbed the shock. Daniel is not careless. He is simply operating on the same assumption most households share, that unless the war shows up directly in his paycheck or his gas receipt in a dramatic way, his financial position is unchanged. That assumption was always incomplete. Now it is dangerously so. The prevailing belief across the investing public has always been that Middle Eastern conflict produces a predictable, temporary pattern. Oil spikes briefly, gold catches a bid, treasuries attract flight capital, then everything returns to baseline. This belief rested on several pillars: that energy markets are sufficiently diversified, that strategic reserves provide a buffer, that the United States produces enough oil domestically to insulate itself, and that diplomacy ultimately contains sustained damage. But what happened in late February did not follow that script. Negotiations in Geneva collapsed. A 10-day deadline from Washington expired without a deal, and a military operation of a scale not seen since the 2003 invasion of Iraq was already positioned. The pillars that supported the old assumption did not hold, because the scenario they were designed for was escalation, not war. The structural mechanism that most people misunderstand about a conflict like this is that the financial damage does not require a prolonged ground war to take hold. It does not even require a direct hit on oil production facilities, though Saudi Aramco has already had to halt some refinery operations after shrapnel from a nearby drone strike caused a fire. The real transmission channels are the ones the market cannot easily price in a single session. Insurance premiums on shipping through the Gulf have not just increased. Coverage has been pulled entirely, effective within days. The repricing of crude oil futures curves is not a temporary spike. Brent has surged past $80 a barrel, with analysts projecting triple-digit prices if disruption continues beyond a few weeks. European natural gas prices have jumped dramatically after Qatar ceased liquefied natural gas production due to Iranian drone attacks on Gulf infrastructure. And the anticipatory behavior of central banks and sovereign wealth funds, the quiet repositioning that precedes any public statement, is already underway. The financial risk was never the explosion. It was always the repricing of uncertainty itself, across interconnected systems operating on thin margins. That repricing is now happening in real time. If this kind of structural economic clarity is what you have been looking for, the kind that goes beneath the headlines and into the mechanics of how a distant conflict reaches your household budget, subscribing to this channel is the simplest way to keep it in your feed. To understand why this reaches Daniel in Ohio, you need to follow the chain further than most coverage takes you. The Strait of Hormuz carries roughly 20% of all global crude and a significant share of the world's liquefied natural gas daily. When Iran's Revolutionary Guard declared the strait closed and threatened to set fire to any vessel attempting passage, the physical blockade was almost secondary. The economic blockade happened instantly. Shipping companies and their insurers made rational decisions not to risk vessels. Maersk and Hapag-Lloyd suspended all transits. Over 150 ships anchored outside rather than enter. The result is not a temporary delay. It is a structural disruption to energy supply chains that feeds into transportation costs, agricultural inputs, manufacturing, and ultimately every consumer price category in developed economies. This is not a theoretical chain. It is unfolding now, and its effects will compound over weeks, regardless of whether a ceasefire is reached tomorrow. The system that made this possible was decades in the making. Western economies constructed supply chains and energy dependencies that route through geopolitically sensitive choke points, corridors that function invisibly in peacetime and become pressure points with no proportional alternative in conflict. Alternative pipelines exist in Saudi Arabia and the UAE, but analysts have been clear that these accommodate only a fraction of normal Hormuz volume. There is no meaningful substitute for the flow that has now stopped. And here is the structural detail that matters most. Each previous escalation cycle, the tanker seizure attempts, the drone shootdowns, the proxy exchanges, did not reset to zero when headlines faded. Each one added a new layer of institutional caution, a new insurance premium, a new contractual complexity. The baseline shifted upward every time. This time, the floor did not just rise, it fell away entirely. This is the kind of layered structural reasoning we build every analysis around. If you find this approach valuable, consider subscribing. It is how we continue producing work like this. Now here is where Daniel's life starts to change in ways he will not fully understand for weeks. The groups most exposed to this kind of embedded financial stress are not the ones who see themselves as vulnerable to foreign policy. Middle-income households carrying variable-rate debt face a specific kind of margin compression. When energy-driven inflation forces central banks to hold restrictive interest rate postures longer than expected, and Treasury yields have already posted their largest advance in months on inflation fears from this conflict, the cost of that debt stays elevated. Bond markets are already pricing in reduced odds of a rate cut. Daniel's mortgage rate is not rising because of anything he did. It is staying high because of a repricing chain that started in a shipping corridor he never thought about until last weekend. Small and mid-sized businesses feel it differently, but just as sharply. Firms operating on thin margins in logistics, food service, and light manufacturing absorb input cost increases they cannot fully pass through to customers. With European natural gas prices surging and diesel futures hitting multi-year highs, the cost pressure is not abstract. It is arriving in invoices this week. Retirees and fixed income holders are watching purchasing power erode in real time. And at the portfolio level, the market reaction tells its own story. Energy and defense shares gained, while airlines and cruise lines fell. The rotation is underway. But the deeper damage is in the sectors and households that do not make the evening news. The second-order effects are where the genuine financial risk concentrates. Sustained energy cost elevation compresses corporate earnings forecasts, which tightens credit conditions as lenders reassess borrower risk. Consumer credit utilization rises as households bridge the widening gap between stagnant wages and elevated daily costs. The dollar has strengthened as a safe haven, which helps import costs but hurts American exporters. Gold has surged past $5,300 an ounce. And labor markets may continue to appear superficially strong while real wage growth quietly deteriorates. The economy can look stable on the surface while household balance sheets are eroding underneath. That disconnect is not a future risk, it is the present condition. The most revealing misinterpretation playing out right now is the idea that because the S&P 500 recovered on the first trading day, the market has priced in the conflict and moved on. It has not. What it priced was the expectation of a short, contained operation, roughly 4 weeks of disruption based on the gap between current oil prices and estimated fair value without conflict. That is a bet, not an assessment. If the strait remains effectively closed beyond that window, if Iran's retaliatory strikes continue expanding across Gulf states, the repricing enters a different phase entirely. The market did not shrug because the risk is small. It shrugged because it is betting the risk is brief. And that bet has already started to look less certain, with stocks plunging on the second trading day as the conflict showed signs of widening. So what does structural awareness actually look like in this environment? It starts with recognizing that geopolitical risk premiums do not disappear when a ceasefire is announced. They accumulate in layers: higher insurance baselines, rerouted supply chains, elevated compliance costs that reshape cost structures permanently. It means understanding that energy exposure permeates every consumption category and every business that depends on physical goods moving through a supply chain. It means maintaining liquidity buffers that account for the real possibility that restrictive monetary conditions persist longer than consensus expects, because geopolitical inflation is the kind central banks cannot resolve with a single rate decision. And it means resisting the impulse to treat de-escalation headlines, when they come, as confirmation that the structural repricing has reversed. The baseline has already shifted. The question is only how far. If you appreciate analysis that prioritizes structural understanding over reactive headlines, subscribing is the best way to stay connected to this work. Daniel, back in Ohio, checked his portfolio again this morning. The second day was worse. The Dow dropped over 700 points. Oil pushed past $83. He is starting to wonder if this is different. He is right to wonder, but the financial impact that will matter most to Daniel over the next year will not come from a single red day on his brokerage app. It will come from the grocery bill that rises and never comes back down, from the mortgage rate that stays elevated 2 quarters longer than expected, from the earnings revision at the company inside his retirement fund that nobody explained was connected to shipping insurance in the Persian Gulf. And that may be the most important financial insight embedded in what is unfolding right now. The risk was never that something dramatic would happen. It has. The risk that persists is that something gradual follows, slowly enough to avoid the alarm bells, persistently enough to alter the financial trajectory of millions of working professionals who, until last weekend, had never once thought of themselves as exposed to the Strait of Hormuz. The system does not send a notification when it has repriced. It simply continues. And the gap between what people believe about their financial position and what the structure has already decided, that gap is wider today than it was a week ago. It will be wider still before most people notice.